Welcome, everyone, to another episode of the Deal Flow podcast. We have a panel for you guys today. Got some heavy hitters that we're going to introduce, and we're going to have a great discussion around the multifamily market, what we're seeing today, and what we see coming up in the future. First, we have Hans Box. Hans is founder of Box Wilson Equity. He's been involved in over $350 million of multifamily and self-storage acquisitions, transactions. He's a CPA by training, so watch out. He started at PwC, then spent 5 years running acquisitions and asset management for a DFW, that's Dallas, multifamily operator before launching Box Wilson with his partner in 2014. He's been a GP on over 4,000 multifamily units and is known in the industry for teaching LPs how to properly vet deals and spot red flags. Hans, welcome to Deal Flow.
Thanks for having me, Michael.
Next we have, and I'll pass it back to you to fill in some blanks in a minute. Next, we have Doug Wilson. Doug is Hans's partner at Box Wilson Equity. Before real estate, he spent a decade at Texas Instruments and ran a division of over $40 million of annual revenue. He has his master's from Stanford in electrical engineering and brings an analytical rigor to everything he does. Doug's been involved in over $200 million of real estate transactions since 2008 and brings a macro data-driven lens to market analysis. Doug, great to have you.
Thank you.
Great. And last but not least, Cody Littlewood. Cody is the CEO of Carbon Real Estate Investments. My partner on the operator side. Before real estate, he built a software company from 0 to 70 employees. At Carbon, we've built a vertically integrated platform. He's largely responsible for the work that goes into that and acquiring Class B workforce housing in the Southeast and managing it through our Carbon residential property management arm. Cody's been the driving force behind our property management strategy and our focus on aligning incentives between our teams and our investors. Cody, thanks for joining.
Thank you.
Long time since I've talked to you. No, I'm just kidding. All right. So with that, I'll, pass it back to Hans. Anything about your background that you want to fill in the blanks that we didn't talk about?
No, not particularly. Yes, I worked as a CPA / more consultant for about 9 or 10 years at one of the big four, and then got into real estate, where I met Doug a few years later, and spent quite a bit of time at a boutique multifamily firm in Dallas, where I was essentially a third on the totem pole. Small company, so basically doing everything, and we were direct owners in about 700 units when I came on, and when I decided to leave and go full time with Doug, we were around 3,000 units or so. So that's a brief elaboration of my history.
Great. All right, and Doug, any other blanks you want to fill in there? You have some shared history with Hans, but any other electrical engineering?
I was in a small little boutique firm too. I think we bought maybe 6 or 7 apartment complexes back in the day before Hans and I really joined forces. Hans and I met in a deal that went south. We were LPs in the deal and took it over. And really that's what led to us and launched our business, was turning that business around.
Oh, interesting. Okay. Well, I may come back to that in a second. Cody, any last words around your bio that you want to fill in the blanks on?
No, I think you covered it pretty good.
Okay, great. Well, let's circle back to that. It sounds like there's a little bit of a good origin story there, Doug and Hans. You want to speak to that deal in particular and maybe what you brought from that deal into how you look at opportunities today?
Sure, I can take a quick stab. I mean, I remember the day that Hans called me. So Hans and I were LPs in the deal, and the deal wasn't going well. And I remember one day I'm at a bar actually downtown in Dallas, and Hans called and he's like, we got to do something. This deal's not going well. And that led to many discussions, and which eventually led to entire partnership supported bringing someone new in. We had a couple partners who really supported us and drove that. Once we were brought in, we convinced the other GP to step aside. We brought in a new property management company, totally turned the property around and sold that at a profit a few years later. This deal we'd been in for 2 years and hadn't cash flowed at all. And I would say one of the things I learned from that, which I think will come up later in today's discussion, again, is how important the operator is on the deal. And, that deal was bought right. That deal was, it had every opportunity to perform, and it just wasn't run well. And it didn't succeed until we brought in the right person to run it. And I think I've seen that theme repeatedly, and I think we'll talk more about it today.
Well, that's a good origin story, and it proves the value of having a strong operator. So obviously the three of you have worked together on deals before. Maybe talk a little bit about the dynamic. I know you guys all have varying backgrounds. And so maybe Cody, for you, how do you feel like your perspectives complement each other with the dynamic between you and Doug and Hans and in the deals that you guys have done together?
Yeah, I guess, I mean, I think Hans and Doug are incredibly analytical and have, obviously having a CPA and, finance backgrounds. And I think, much more impressive education backgrounds than me are incredibly analytical and detail oriented. And I think that having that on the, especially on the investor relations side, on the analysis side, we've caught a bunch of things, we've learned a bunch of things. And I think, uh, I think it's really made us better operators to dig down into the nitty gritties. And it's always good to have somebody, kind of up there, out there checking your work. And so, yeah, I think it's always great to have like stress test type friends and partners in any situation. And at the end of the day, they have strong operational backgrounds as well. And so they understand the challenges on the ground, and they understand, how those things need to be fixed. So I think anytime you are working with folks that, are very similarly aligned, on a values basis, and also, very sharp and detail oriented, which is not what I'm good at, right? Like I'm good at operation, like big things and, pounding pavement, but I'm definitely not good at sitting in front of a financial statement and catching something and being like, oh crap. Oftentimes I'll be like, oh, you're right. Like that good catch. And yeah, so I think a lot of those things have really been how we've complemented each other over the years.
Awesome. I got some comments from at this point, Cody and Doug. So I'm going to pass it to you, Hans. Hans, you've invested in close to, I think it's over 100 or about 100 deals as an LP or a GP. Tell me a little bit about what, I guess you must have noticed patterns from all of that, those deals, right? Over all of those vintages, all those different operators. Anything to add that you could point out other than the operator that maybe you could add a little nugget there on what you've learned from all those investments over the years in this space?
Well, I mean, I think when you say operator, there's two operators, right? And Doug was talking about two operators there. One of those being the management company itself that's running the day-to-day, and then two, the sponsor, right? And so Doug and I became sponsors in that role, in those deal. So what I've learned basically in being in so many deals as an LP is a sponsor is everything. To me, it is the number one reason to do a deal or not do a deal. Yes, the deal itself is important. Yes, the market's important. Yes, the waterfall and compensation models and all those things are important. But if you had to pick one thing that is the most important in a deal, being from an LP perspective, is who's steering the ship, right? A sponsor is not the day-to-day manager. He or she is steering the ship. And that person or persons are the most important part of any deal. And I've learned that over and over and over. And there's ways to vet that out and figure that out as best you can. But it becomes a little bit, it's a little bit more of an art than a science, and it's learned on repetition.
Okay, yeah, I'm sure we'll get into that a little bit more later. I want to pivot a little bit to Doug, something that you had brought up during kind of our prep for this. And you were talking a little bit about population trends. Obviously, there's a lot of noise around immigration, and we definitely seen particularly a reduction in immigration. Certainly for this year, we'll see if that continues in the future. And you flagged something from Starwood's recent earnings that the U.S. population might actually decline year over year for the first time in quite a while, over 100 years. Maybe could you walk us through that a little bit? What do you think is going on there?
I mean, I guess I would start by saying, when we're looking at markets to go into and deals, we're often concerned with what's going to happen in occupancy, right? And if an area is declining or an area is growing, and we've looked at so many deals that are in areas that are declining that we've run away from, that we've been thankful that we did, because it just makes everything more challenging on the occupancy side. And so, one of the things we're looking at is how do we pick areas that are growing? And, when I heard this mentioned the other day, it just struck me as, oh, wow, if our country's not growing, how's that going to impact the areas that we're in and the country overall? Turns out around 4/5 of the growth that we've had the last few years has come from immigration, and we know immigration has slowed down dramatically. If you dig a little bit deeper, you'll see that most immigration seems to occur in the bigger cities, Miami, New York, San Francisco, LA, also Atlanta and Houston, which are areas that we're invested in. And so those areas might take a little bit more of a hit. The nice thing about the Southeast, though, is we have this beautiful, in-migration coming from the rest of the country, which is helping to offset that. And I think, for that reason, we may see less of an impact in the Southeast where we're investing. So I think it really depends on the market. Georgia, outside, except for Atlanta, Alabama, Northern Florida, most of these areas probably won't be impacted as much by a slowdown. I mean, the other factor I didn't mention is that, birth rate is not above where it needs to be to break even in the country either. So we do need immigration, aside from, just to break even, without slowing down. So I was about to say, saying goes, I do think it depends on the market, and we'll have to look at each of the areas that we're in. I think our overall, we're not going to be super impacted as much as some areas, San Francisco, LA, Miami, they might actually see a population decline. And if that happens, I think, occupancy and multifamily there is going to be a challenge. And the areas that we're in, I'm not sure yet that we're going to see much of an impact.
So I guess, Hans, like from a due diligence perspective, how should LPs be thinking about that, and how they should be stress testing, or what questions should they be asking maybe of sponsors, about those demographic assumptions and how it's going to affect the deals?
Yeah, well, I mean, the first thing, regardless of whether or not we're having immigration or not, or population growth or not in the country in general, every deal that you review as an LP, in my opinion, should have at least at least 1 or 2 pages in the deal deck that kind of dive into the market and dive into the submarket, and not just the boilerplate. Birmingham, Alabama has X amount of by Fortune 500 companies or things like that. More diving in truly into what the population growth is, and basically the working age, population growth, per capita income, and you want specific statistics in a 1, 3, 5, and maybe even 7 to 10 mile radius of the subject property, so you can get a sense of growth and trends. So what I would look for as an LP is evidence that the sponsor has really dived into the details and understands the demographics and understands the growth and the profile of the submarket itself, and whether that growth matches, the demographic and the type of property that they're buying, and whether or not it can fill it up. So it needs to support their value add proposition, which we all know the value add proposition is the entire reason you do a deal. And so you want to be able to, as an LP, vet out that they dove into those demographic statistics and can support their value add strategy.
Yeah. And Cody, you're on the ground, as you said, you're operating, you're pounding the pavement, and you're operating primarily in some of these markets that have seen pretty significant both in migration as well as immigration. Are you seeing things in Georgia, Alabama, Florida? Are you seeing any of this happening on the ground? Any changes to tenant composition or demand patterns in your view?
We haven't seen anything as a result of, as a result of any changes in immigration policy. I mean, we're largely in what I would already consider unaffected markets. Some markets, Birmingham, Northern Florida. I think Doug had pointed out or looked up earlier, and I think Northern Florida, Birmingham, smaller submarkets of Georgia, essentially unaffected, which rhymes with what we're seeing on the ground. The biggest sources of changes in demand, I think, we're really on the backs of inflation, tightening consumer, and just generally, the kind of decline and crunch post-COVID of financial tightening, right, in QT. And so I think that's where we generally saw differentiation in demand. And I pound the table on this one a lot. I think it'll be interesting to kind of figure, to see what the effects are, but it is incredibly hard to measure the effects of demand. So there's a book called Capital Returns by Marathon, and they make a pretty good argument that it is very difficult to measure demand until after the fact, or, the demand side until after the fact, but much easier to measure supply. And so especially, you could look at, he's specifically talking about, many, I guess, broader public markets in many different ways, right? You could look at oil, you could look at CapEx spending in AI, you could look at, all sorts of stuff. But for us in real estate, it's also very true, right? You can see permits, you can see multifamily starts, you can see pipeline. It takes 2 years to build, at least, right? And it takes probably 3 or 4 if you include land and permitting, right? And that's all public record. So it's much easier to measure supply than demand. And I got to say, as far as I have seen so far, the larger impact of, on rents and, the demand that we feel has been supply in markets. So, markets where we didn't have any supply, essentially unaffected. But, we see supply come online and you got three brand new buildings down the street with their sponsors trying to get into fixed rate debt. And they're offering 3 months of, 3 months free on the rent for Class A brand new building. And yeah, you're going to see demand impacts as everyone just kind of flocks to that. And yeah, they're going to have a problem later, but they're just trying to put warm bodies in those buildings initially. And so, yeah, so my kind of general 2 cents is we haven't seen anything by way of immigration. Largely demand impacts have been, a tightened consumer, worsening credit, credit worthiness of consumers, and, and impacts from supply.
Mhm. Yeah, definitely. I think on the supply side, to your point, you have a really long runway, and you can kind of see where those deliveries are going to happen, and be extra sensitive to investing in those submarkets. And we've definitely seen that come out. If you look at some of these markets like Austin and Phoenix, I know there are these other markets have really seen some rent declines. They've had a lot of migration, but they've also had a lot of supply they've had to absorb. So longer term, still really great opportunities, but in the short term, you got to deal with that absorption. You got to deal with that rent growth. Cody, did you have or rent decline? Cody, did you have a follow up?
Yeah, I mean, it's just I guess this is like more anecdata. But two, I think, what was it? Uh, to their point, right? The folks that said, like, the majority of net demand has really been, I think, or somebody said 100%. John Burns, I think, said 100% of net additional demand was from immigration over the past like few years. This is just anecdata, but I had a buddy who Hans knows, Bernard. They had a deal that they were selling and sold now, so I think he probably won't mind if I say it. But they had a deal that they were selling, and the deal got raided by ICE, and they dropped massively. I mean, not the deal; it wasn't like their fault, right? But the building and the surrounding area, had a bunch of ICE raids, and all of a sudden, landlords aren't responsible for immigration, right? So it wasn't their fault. All of a sudden, they had a huge impact at that property as far as it was a heavily Latino area of town, and they had a very heavily immigrant population, that was living there, and it had a massive impact on occupancy. So, I mean, that's just one deal, and maybe that's just like a spot case, but I'm sure it's happening. If it's happening someplace, it's, where there's smoke, there's fire. So I'm sure people are dealing with it. And then, and then let's say it's a 100-unit building, it drops from 100 to 75, and you got 25 things that you got to lease up. And now people are scared. And so you're really only, you're probably really only renting to a smaller demographic now, because so I mean, I think that's going to have some impact for sure.
Yeah, definitely seems it's case by case, location by location, and circumstantial. And of course, it's politically driven in some cases, right? So today we don't like immigration, but in a few years, when we realize that we maybe need immigration to continue to grow our economy, the political environment may shift a little bit. So we'll have to see. What happened this year doesn't necessarily apply in the future. We're definitely keeping an eye on it. So
well, maybe if the rest of us can take whatever fertility drugs you're taking, we can help.
These
help that.
I have thousands. Yeah, right. Exactly. That's an interesting one. No comment. So moving on from fertility to birth rates to inflation. So Doug, you are looks like our key researcher for this week. You brought up something else about inflation, which I think is really important. It's kind of a nuanced topic around how inflation is actually calculated, and with specific attention to owner equivalent rent. Could you maybe speak to that a little bit, and how that maybe is distorting the current inflation picture?
Yeah, I actually found this surprising a little bit over the past few years. I mean, of course, we've all seen massive inflation. We see it everywhere, but it has slowed down tremendously. And I think if you look at the headline numbers, inflation still looks very hot. But there's one factor that's built into there that people don't really talk about. You don't hear it on any of the news segments or radio shows, and that's this concept of owner equivalent rent. And the statistics are basically applying a rent to people that already own their homes as if they were impacted by these higher interest rates. So many of these people that own their homes have already paid off their homes. And I don't know what the latest stats are, but it's actually a really surprisingly high number of people that own their homes outright. And then of the rest, many of them actually have fixed rates set from before, interest rates went up. And so now there's this owner equivalent rent that at today's rates that are applied to everyone, regardless of what they own their home, regardless of whether they own it outright or not. And, if you look at rents, we all know that nationwide rents have been pretty flat the last year. We haven't seen a massive rent growth. And so this inflation component really has this built in, these inflation, high level inflation numbers have this owner equivalent rent built in that's distorting it and making it look like inflation is actually higher than it really is. Now, I know that there's some inflation on materials and some things going on with the tariffs, but the high level numbers are actually a little bit better than they seem given this owner equivalent rent.
Yeah. So and this could be for anybody, but if we continue to see inflation running hot because of maybe these distorted figures around owner equivalent rent, it's not really driving rent growth. But obviously the Fed is paying attention to PCE and, these inflation measures. And so they're seeing high inflation, and that may require them or encourage them to stop cutting rates or even maybe raise rates to offset that at exactly the wrong time when we're not seeing the price growth on the rent side. I don't know if anyone has any thoughts, either Cody or maybe Hans, on does that create a potential issue in the future for Fed rate cuts expectations and the environment, the multifamily environment going forward?
Well, I'll give you my 2 cents on that. I mean, essentially, I don't know how, that necessarily affects future rate cuts or decreases because they're basing it on the figure we're talking about. But essentially, if they're using the wrong CPI number and they either don't decrease rates or increase interest rates a bit, that will lead to higher cap rates, which lead to lower asset prices, right? But at the same time, we have weak rent growth, so thus meaning our NOI in our multifamily assets aren't keeping up with inflation. So valuations can get pressured not only by the fact that rents are flat or stable or not going up. So valuations are pressured there, and they're pressured by the potential rise in cap rates if interest rates go up. So that's why deals feel tight today. And even though that we think we're in an inflationary environment. And so that's kind of I guess I kind of gave a summary of what you were talking about, but essentially, I think, the opportunity here is to find needle in a haystack and to be a really good operator and to out operate. That's where you are able to get ahead of the competition. Because if you can get a deal that, is where you basically have to operate very well to out operate your competition, that's where you can get ahead in this current environment until hopefully interest rates either go down a bit or rents start going up, which I think we all believe will start as the supply side falls off a cliff here in the next year or two. Every market's slightly different, but in general, in the U.S., permitting and supply is expected to drop significantly over the next 2 years, and demand is not supposed to drop.
Yeah. So I guess, Cody, on the ground, you mentioned a little bit about the struggles that the workforce housing tenant base are going through with persistently high food inflation and just strapped, household budgets. Do you see that sort of pressure on the ground when you think about what kind of rates people can accept in renewals or what decisions they're making on the ground as it relates to maybe premium units versus classic units, like the decisions they're making for their household budget? How's that affecting the tenant today?
Yeah, I mean, to comment on kind of everything, I think that it's a weird environment, and they've maybe accidentally manufactured stagflation. Where you have, they're being forced to cut in the face of a weaker than anticipated job market. And I think the numbers are, continually are coming out and looking worse and worse and worse and worse. And, they're notoriously always behind the ball of what's actually happening. I think people have been pounding the table of, that things are worse than reported for quite some time. But so they have to, start easing. And I think they just announced that they're going to buy 20 or 40 billion of bills this month. So they're not calling QE, but I would say QE's kind of started. And so, but you're in the face of I think a consumer that's already really stretched companies are stretched, everyone feels stretched, prices continue to kind of move up, and there really hasn't been that relief, right? So either we'll see something break and that'll be our relief on the inflation side, but then we'll still be in a cutting cycle, or we won't see something break and we'll have this weird like stagflation scenario, which I think will be bad but won't be awful for us, because where we kind of rents really pulled forward, had kind of pulled back inflation, or pulled forward inflation. We saw the majority of rent increases through like 2021 and 2022. And then, all the expense side was on the back half of like 2022, 2023. So if we're going into a time of, I think, easier monetary policy and the labor market doesn't totally crack and break, then you're probably, you're going to start to see rents rise, with everything else. Everyone's costs are rising, right? And so, I think those will kind of, flow in line with each other. But what we're generally seeing from tenants is they consistently are willing to pay, or are willing to forego the top of the line unit with all the latest, greatest renovations in order to get slightly more affordable rent. So I think the name of the game right now is to not over improve, right? People are not going to pay up for it, to not over improve, to do, provide, which our kind of philosophy, good, clean, safe unit, homes for folks in good areas, right? I think people still want to be in a good area. No one is, for the most part, what they will compromise on is a black fridge versus a stainless fridge, but they won't compromise on the ghetto versus the great area next to Whole Foods, right? And so I think that's generally what we're seeing right now. People feel really stretched. Consumer credit is worse than we've ever seen it. Everyone seems to be behind on payments when they're coming to apply. I think, application quality of tenants has been very difficult recently. I think we've it's an arms race in renter fraud that they keep playing, where they are able to utilize new tools, and everyone seems to be fine manufacturing fake pay stubs, and even fake social security numbers and all sorts of stuff to try to get approved. And I think right now landlords are on the stronger side of that arms race. We weren't, like, maybe a year and a half ago. I feels like we're on the stronger side of that arms race, but in turn, the legitimate credit of the folks that we're seeing right now, I think is in worse shape. I think people are really stretched. And consumer preferences, that's what we're kind of saying, is like, pay a little bit less, but not have a top of line unit. I think, and what does that look like, right? That means instead of paying $1,350, $1,400 for granite countertops and stainless steel appliances and a Nest thermostat and all brand new fixtures, an LVL throughout, pay $1,200, $1,250, black appliances, Formica countertops, maybe just a standard backsplash, LVL in the common areas, carpet in the rooms, and certainly not top of the line fixtures, right? Just a clean, safe, good unit that they can decorate nicely.
Yeah. And
I would just add one thing maybe, which I think,
yeah,
since we're talking about inflation, I think we're in this really special moment right now. And I don't know that everyone necessarily recognizes it if they're not in the multifamily investing business. And that's that we've seen some pretty big inflation on expenses the last few years that have been a challenge for operators, but it's also brought property values down it's impacted property values. We've seen pretty big inflation on rents over the last decade, but a lot of that came from just lack of supply. Now we've had this big surge in supply the last few years that have brought rents down, or kept them flat, or brought them slightly down. And so we have this little kind of, I feel like, this magical NOI moment right now where the income from the properties is down because expenses are up. The income of properties is down or flat because rents are flat or down due to new supply. Interest rates are high and cap rates have been, are in a comfortable spot. And we can just find these properties as such a sweet spot in the NOI and cap rate, given where NOI and cap rates are today. And so, we're well positioned now. So if, as supply has dwindled, we're going to see rents start coming up. As expenses and inflation have stabilized, we're going to see expenses stabilize. And if cap rates start to come down at all, we're just going to see this massive lift on values. making this just a really incredible time to buy. So I think it's like just this, I've heard the term generational opportunity. I feel like the generational opportunity was when we started, 10 years ago, but it could be another generational opportunity. I mean, this could just be this
Another
really
once in
special,
a lifetime opportunity, right?
it's another really special situation. Yeah. And I
Yeah.
think, on interest rates in particular, I remember, and you guys, I'm curious what you remember, like 6 years ago, we were like terrified to buy more stuff 5 years ago because we're like, oh my God, interest rates, as soon as they go up, everyone's going to get pulverized, and so you're afraid to buy. And right now historically, interest rates are pretty low. They're not where they were, but historically they're pretty low. And if it's a more comfortable place to be buying, knowing that, we're not at the lowest ever in this really dangerous position. So like add all that together and it just feels like a really spectacular time for multifamily.
Yeah.
And there's certainly risk from immigration and all kinds of things, but it's such an incredible time.
Who was it that
Yeah.
said the time to buy is when you really don't want to, or when you're, when it feels awful,
Blood in the
right?
streets,
And when there's blood in the streets, I mean, everyone just got their teeth kicked in the
Yep.
industry, and a lot of people in the general public do not know that. Like, they have no idea. They're like, "Oh, real estate's been doing great, right?" Because for most people, for 99% of people, real estate means single family homes. They don't realize. I think the group you guys work with called Rockport. They put out an amazing, they just did a little research comparing the last few years in multifamily and commercial real estate to the great financial crisis, and it was on par or worse
It's worse.
than and so and I don't think people like fully comprehend that. It has been an incredibly difficult time, and I think a lot of investors, a lot of capital out there feels over allocated to it, and but that is, to Doug's point, that is the time. That is the time to be buying, right? The time to be buying is not when everyone's bullish, right? That's the time to sit back and start selling. The time to be buying is when everyone's terrified and just got their teeth kicked in.
Yeah. I mean, we're investing heavily, and I get a little nervous sometimes, and then I'm like, nope, this is exactly when we should be.
You hear like Howard Marks talk, and he said, he had this really good interview recently, and he talked about like being younger and like what has always been like really easy for him. And he says, being able to take the emotion out of it. Like he's just, logically, it just makes sense, right? Like if I can, if I can buy this and, if you take all the logic out of it, right? If you're buying at, very fair cap rates with a solid spread above treasuries, and you can walk into a deal with low leverage and good cash flow, day one, and you have good free cash flow in that business, you have a strong opportunity and a dearth of supply ahead of you, and they're about to turn on the money printer, right? Those things combined, right? I think you have a lot of downside protection because of your free cash flow, and you have a lot of potential upside, because it's going to be the beneficiary of of an easing, monetary policy. And if it's not, it doesn't seem like there's, it seems highly unlikely, nigh impossible that that they're going to let the interest rates go the other way, just because of the pure impact of interest expense to the federal budget, right? They can't afford to let them go too far the other way. And so if you're already kind of sitting at the high end of what they can afford, I think there's a pretty strong argument to be made that, you got low downside protection, a lot of potential upside.
And you're locking in these rates anyway, so it's how risky is it until you're, and I saw, Michael, you recently posted something about let's plan for the 10-year, make sure it works the 10-year, because it gives us plenty of safety, even if we don't really need to hold it that long. I think that's true. I think it gives a ton of safety.
Yeah.
I think sometimes people
by the way, one other anecdote I thought was interesting the other day. We were on a call, actually, it was a call you guys were doing yesterday. One of the investors at the end of the call made a comment. He said, I don't really like value add these days. And Hans pointed it out, and it hit me too. And I was like, wow, like people, and it's to your point, I think people have been burnt by a few things, and they really want to get into deals that like have this high cash flow now. And I absolutely think, I think this guy couldn't be making a bigger mistake. because I think they're trying to get into short-term, high cash flow deals that are risky, rather than getting into deals with a value-add component that have tons of safety, just massive amounts of safety on them. And I think I really believe that anyone who's sitting there today thinking, I don't want value add because they think that's safer, I think there's nothing that's safer than value add right now, where you have the safety coming from all the margin you're adding from the changes that you're making.
Well, if you don't have value add, then you're just buying a deal at market. And so it basically, if there's no value add, you shouldn't be buying a deal in real estate, period. I mean, the only time I could argue that there's no value add and you buy something is if you've got, you have generational family office money and you need to place 40 million into triple net, CVS leases somewhere and make your 4 or 5% and just ride along with inflation and protect your money. That's different. If you're investing to make money in real estate, there has to be a value add component, which is why that comment by somebody in a very large investment group with obviously a lot of money was shocking to me to see that they are afraid of value add. I'm like, that's the entire point of investing, actually.
Mm-hmm. Yeah. I think maybe value adds got a bad rap because it's almost like every deal, right, is named value add, right?
Well, every broker has a value add.
Yeah, this is how you're going to double your money in 3 years.
Value add is you being able, us as sponsors, to be able to comb through all that bullshit.
Yeah, let me tell you about this stupid seller and how much he hates money. Right? Right. This guy, he fucking hates money, but you, sir, are smart and you like money, right? And you're going to be able to do this. So that's every broker.
And that's I think I think so. I think it can be it's you can consider that perspective of an investor who they've been burned by these value add deals. At a certain point, there's just so much juice you could squeeze out of a deal, right? And so when it's turned over 4 times since 2008, 5 times since 2008, that you've squeezed everything you can out of that deal. And so the next guy is getting a story from the broker about how, hey, you're going to bump another 125 because the last guy and the last guy and the last guy. And at a certain point, there just isn't another 125 or 150 to go. And the population, to Cody's point, just doesn't necessarily want to pay that delta either. Like the taste of the consumer, that tenant changes over the cycle and they're just less receptive. To me, this feels, to Doug, your point, very similar to that post-financial crisis period where, interest rates were stabilizing, it was recovering. You started to see more and more transaction activity in that 2010 to 2013 range. What was a little bit different is that period, I think, went quite a long time before, you could lose your people lost their shirt a couple times on deals thinking they were getting into the early cycle. But I think that right now we're seeing a similar setup to what you had said, Doug, is, the rates are stabilizing. We're going to get, I think, a more accommodative Fed as time goes on. I think the Trump administration is going to really push that, and the new Fed governor. And so that's really, I think, going to be constructive to the space. And we are seeing institutions starting to buy up workforce housing. So that's definitely happening. Transaction volume this quarter just recovered from pre-pandemic levels. So we're seeing the investment activity pick up. We're seeing rates normalize. Cap rates have stabilized. So the bid-ask spread has started to come in. So I think, this next few years does represent a potentially strong opportunity. Obviously, there's always opportunity for the government to mess it all up by potentially getting in the way in some way. But that's always the case. You just got to protect on the downside there. Anything else you guys want to say regarding inflation?
Yeah. One little thing, and I mean, we could probably move on pretty soon, but the other thing we haven't really talked about is investor demand. And I'm kind of curious myself. I don't have a lot invested in the stock market. Some people have everything invested in the stock market. I'm very heavy real estate, obviously, but I wonder, as there's so much fear out there around an AI bubble. And I think a lot of you see a lot of big investment firms pulling away from NVIDIA and pulling away from other AI firms right now because they think there's a bubble and it's going to, is it Michael Burry or whatever, the guy who did The Big Short? He thinks there's a huge bubble. So I think, I wonder, we're going to start, I think, seeing people pulled out of the stock market and start looking for safer places to put their money, and I don't know when that's going to happen, but that could drive more interest in real estate. I'm actually kind of hoping it doesn't happen anytime soon, because I think once it starts happening, rates are going to come down and it's going to be hard to buy deals, and there's going to be a million more people trying to fight for the same deals. I'm hoping it doesn't happen right away, but I think it is going to happen. And hopefully we can buy as much as we can before it does. And then the other thing is, I think people have been parking their money, some of them, in bonds, and the bonds, short-term bonds anywhere now, are collapsing with the Fed dropping rates. So, I think that's going to drive some more demand in real estate too. So, like I said, hopefully we can buy a lot over the next year and a half, and before really that starts impacting us. But I think that could be a really nice long-term lever for anything that we're buying now to really boost our returns, a few years down the road.
Yeah.
I'm a
And
little
we
more
saw that.
optimistic that we have more
What?
time.
More
I was
time.
gonna say I'm a little more optimistic that we have more time, because I think Doug's right in the consequences of like the AI bubble, right? And an eventual bursting. I mean, I think it's very clear we're in a bubble. You have companies, I think the whole $1.2 trillion of commit on, $13 billion of revenue is probably,
They're 50%, ratios on.
yeah.
I think NVIDIA is, I saw a presentation the other day, NVIDIA itself, market valuation is greater than almost every country in the world except for the US and China and maybe one other. Like, it's bigger than Italy and Germany combined of
Yeah.
its entire GDPs.
Yeah.
It's just, and there were a bunch of other stats in this presentation too that would just validate everything that Doug and you were saying, Cody.
Yeah, that's wild. I had no idea. And I think, as with every period of exuberance, like, the .com exuberance, it ended up with obviously us having, a lot of amazing tools on the internet, and we'll have a lot of amazing AI tools, but I think their exuberance will get popped at some point. But I guess my optimism that, Doug was a little bit worried about, that I don't know quite needs to worry, is until people feel the pain. I think people I don't think retail will be the ones that get spooked, right? It'll be institutions that get spooked. They'll pour out of these plays. And then as the entire market starts to come down, retail get burned by it. Retail is always the last in, always the last out. And I think that's when they start to, they're really sour because a lot of them got burned in commercial real estate and office and, multi-rate rises, et cetera. So they've been really sour on this, right? But as they get burned, in the AI trade, and in the stock market, and I've heard that from people before. I've heard them say, listen, great deal, but I'm crushing it in the stock market right now. Not that they're doing it, and they're like and
Bitcoin's up
all my
50%. Yeah.
and all my multifamily that I bought at peak pricing in 2022 isn't doing well. And so it's really, I think it's our jobs as investors, like always, is to be contrarian, and to not contrarian for the sake of being contrarian, but to make decisions based on what's actually happening. But you won't see retail do that until they feel the pain.
Yeah.
So I think we got a little longer, is what I was saying. I think we got a little longer than just right now.
Right. I hope that's right. But I want it to hit eventually. So we want it to hit right when we're selling everything, just so cap rates.
Yeah, I want it to hit after I've achieved all my value adds, and
yes,
and the consumers been strong and has lots of jobs. And I want the stock market to crash, but I want all of my tenants to not lose their jobs.
Yes.
Well, that's an interesting setup. So the one thing I would just say about the bubble territory, I think there are a lot of definitions of what a bubble is. One that I really like is 1 year rolling returns on a monthly basis are at 2 standard deviations above the average, right? So that means that your 1 year average returns are just way, way too high, right? And if you're at that level, it doesn't necessarily mean that the bubble is going to pop, but it's saying, hey, if we get to this point, we're in a bubble, right? And then it's
check engine lights on at least. Yeah.
It's anyone's guess when that bubble is going to pop. That happened earlier this year, around when the market started to turn over. And so then you saw, Bitcoin fell, 20, 30%, right? You saw a lot of these technology companies have had some struggles. So yeah, we'll see. I don't know if it's a stock market crash. I'm not sure if that's totally bullish for liquidity in our space, but I think if rolling returns are really high and they start to go down, then maybe people start thinking about, hey, where can I take these capital gains? I'll bring them somewhere else. So I just want to shift gears a little bit. We talked about market, the market being in a bit of a transition right now from the higher rates to lower rates. And then, the rents have come down and we have a lot of supply that's being burnt off. Now everyone I think is looking at 2026 and thinks like, hey, that's gonna be a great setup for the next year. What do you guys think? Do you think 2026 is going to be a really strong year? Are we going to see rent growth pick back up, to the same level that we saw before in the Southeast and some of these growing markets? Do you feel like we still have more supply to work through? I know it's case by case, it's market by market, but I don't know if you guys have a view on next year and what you expect as it relates to that.
I mean, anecdotally, based on everything I'm reading, if you ask my opinion, which you just did, I think, more like 2027. I think in 2026, there will be some markets, yes, that start showing some rent growth and high demand, but places like Austin, where I live now, are still struggling just because of the sheer volume of supply that's come online. Same with Dallas Fort Worth, which we have an investment or two. So the demand side is extremely high, at least here in Texas. I mean, Austin had record absorption last year and probably will again this year, but sometimes don't see it because there's so much supply that's coming online. And these projects, you can't stop mid build, right? You got to finish them.
Yeah.
So high level, I think we're going to see more in 27, in my opinion. That's just from my, anecdotal reading on everything.
Yeah. So Cody, I know when you look at the properties today and opportunities today, I know a lot of it's in secondary markets and their existing stock, but how is the supply issue that Hans was mentioning, is that affecting the properties that you are managing or the markets that you're looking at? And how do you identify those risks, right? How do you make sure to stay away from some of these high supply or high potential supply markets?
We got our we got our teeth kicked in one market, which didn't have a lot of demand growth, but had a decent amount of supply come online, specifically competing product for ours in a downtown product. So yeah, and that's starting to wane, and so you're starting to see that that strengthening. And I think especially going into 2026, into 2027, as some of these no one's putting new money in the dirt right now as far as developers go, so you really won't see that. And then across our other markets, we see little blips. We've had like some small supply delivery, like some small deliveries. But largely, as you know, we stay away from any high supply markets. So we are specifically in markets where, our favorite market right now, where we're trying to buy anything that, that they'll sell to or sell to us, has no new supply through 2027 and has had less than 1% of supply come online over the last couple of years. We have another market where small building came online, but very small, and certainly month or two we saw a blip, but it was less than 1% of the total market supply, and so that absorption happens really quick. But you certainly feel it that the 2 months. So yeah, so I mean, that's generally what we're seeing. So anything that we're going into right now, and we're anything that we're buying, anything that we bought previously, we only have, I think, one market that had challenges on supply, beyond like minor blips. And anything that we're buying right now, obviously, no one's putting new money in the dirt right now. So we have nothing on deck through 2027 that we can see coming.
Yeah. So just a quick, check for CBRE, said that by mid 2025, multifamily construction starts were 74% below where they were in 2021 and 30% below the pre-pandemic average. So yeah. So again, 74% decline from the peak. And RealPage is showing that units under construction at 350,000, that's a 40% decline from what was delivered last year. By 2027, 2028, RealPage projects that supply volumes will be well below historical norms. So a lot of this is playing out in real time, and between now and the end of next year. So we should see a lot of relief. And then on the other side of that is strong rent growth, right? Because there's been suppression of that over time. That rent growth will come back, given all of the demographic trends that we know about and the markets that we like. Shifting, just because we're running a little bit short on time here, we didn't get to spend a lot of time on operational excellence. I think that's an important factor. I think, Hans, you mentioned this in the beginning, that it all comes down to the sponsor, and Cody, you talked about, it comes down to the people on the ground that are operating the properties. So, Hans, you said that, sponsor vetting is more important in your view to deal vetting, right? Not that deal vetting isn't important or anything like that, but sponsor vetting, very important. The jockey matters more than the horse, I guess is the term. Walk us through that process a little bit. When you're, especially in today's market where you have these landmines, right, of the supply issues, you're not, seeing on the news 12% rent growth. And so the LP conversations are probably a little bit harder, right? They're not as willing to invest because they're not seeing as many green shoots as maybe others. What gets you comfortable with a sponsor? What does that process look like?
I mean, really, the main things with the sponsors, I think the biggest factor, the first thing you should look at as an LP is, are they clearly articulating the value add component in their business plan? And so every sponsor is going to have value add, right? But many of them gloss over that term, and many of them don't really support it in their business plan. So I think as an LP, you need to be able to understand what value add means and figure out whether that sponsor is actually supporting that value add within the business plan itself and clearly articulating that. Because if a sponsor can't clearly articulate the value add to a deal in 2 or 3 sentences to you, that's going to tell you something. So ask questions, look for transparency. If they can't support it, they're not going to be transparent. They'll beat around the bush. They'll give you a bunch of legalese, consultantese kind of answers where you read something for 5 minutes and look up and realize it said nothing. Those are the kind of answers you don't want. You want to be able to have clear, concise answers to any of your questions. And then, are they running a scenario analysis? Is the sponsor being forthright and actually looking at the deal and stress testing it, especially in this environment where there can be landmines? One little small change to a cap rate can blow up a deal. Or if you don't get your assumed 4.5% rent growth every year over year, is that going to blow up the deal? I'm joking. It should be a lot less than that. But things like that are what you need. You need to really dive into the details and see if they can support their value add. And have they done the demographic study that we talked about? And then there's just the general sponsor things that you should always do. Are they transparent? Basically, will they take your call just because you're investing 50,000 and most are maybe they're a big sponsor and you're only putting in 50 grand, and so you're a small fish in a big pond, but are they still taking your call? That'll tell you a lot, because when you're investing that kind of money, whether it's 50,000 or 500,000, and they'll take your call, and they won't take your call, or they will be short with you if you ask them a lot of questions when you're investing with your money. What do you think is going to happen if shit hits the fan and they've got your money already? Mm-hmm. I think I don't really need to answer that question. So it's really about transparency, reporting, and is their business plan transparent? Does it actually have a scenario analysis, or is it just 10 pages of boilerplate sales technique? Anything that comes across as salesy, I think you need to run as an LP. The good sponsors don't need to be salesy. They just state their case and state the value add. So it's little things like that. And again, I could talk for an hour just about this and on this kind of thing. High level, those are the things you want to look for as an LP when you're looking at.
Yeah, we'll maybe dive into that again next time we do a panel with you guys. Doug, anything more? You obviously came before real estate. You were in technology excellence. As far as operational excellence is very important. I mean, all businesses really. But what did you maybe bring from your prior experience into real estate, or what maybe surprised you about real estate operations versus some of the other experiences you had previous to real estate?
Yeah, I don't know if it surprised me so much, but I was lucky to start with this boutique firm with a partner who's now joined us again and is helping us with a turnaround a deal. And I really learned back then that having someone who could operate extremely well made all the difference. All the deals that we did were just absolutely killing it. And I was in my own deals, but I was investing and seeing other deals. And I was like, how is it that we're outperforming everyone? And it was really because the lady who was running it was just, she was a stickler on expenses. She was focused on growth. I mean, she really made sure she was hitting everything. And I realized then, like, a good operator just makes all the difference in the world. And I think now, and I'm hearing, Cody say that a lot, and I really believe it. I see deals that aren't operated well, and they we're turning around a deal right now where someone didn't have their eye on the ball, and bad things happened. Employees were lying about stuff. There was, they were saying people were in units and they weren't in units because they weren't verifying that they were actually, this was actually happening. So I think, I would just say, I think the operations is absolutely critical. And I think technology is getting really interesting too. I mean, I stepped away from technology as a career, 10, 15 years ago, but it's now becoming, with AI and all the things that are happening there, and how do we be more efficient, and how do we analyze our stuff and stay on top of everything that's happening very quickly. It's really interesting now, I think, to see how big of a impact technology is having. And I think, that wasn't the case in real estate 5-10 years ago. I don't think there was a whole lot of technology being used. It was very, very simple tactics. So yeah, I would say, I think that all that happening today is exciting and changing things.
Yeah, real estate is a little slow to the bit on technology for sure. I'm still having conversations with people, and they'll say, "Hey, the most innovative thing that we are using technology wise is online rent payments and DocuSign." Hey, they're still the heavy hitters, but I think we can do better, a little bit better than that. We're about to run out of time, and I think so. Next time, I really want to dive in a little bit more onto that operational excellence and what, because that's a term, but like, what does it really mean on the site level, right? Because I think everyone believes that they're going to operate their assets really well, but what does it actually mean to do that in practice? And maybe we could go through some examples of that and give Cody the opportunity to speak to that a little bit more on our next one. But we are at the end of our time, so I'm going to go to our rapid fire questions. First one is going to be for you, Doug, and then the rest of them are going to be, everyone's going to get an opportunity to say a quick thing. So, Doug,
Sure.
If you could invest in one market for the next 5 years exclusively, where would that be and why?
Yeah, thinking about this a little bit, before the call, I saw this question and I thought, I've always thought fastest growth market, that's where we want to be. I'm starting to change my opinion. I'm starting to think areas that aren't growing as fast are more interesting, because the fast growth markets are getting the massive supply and unpredictability. And I'm more curious. And I'm not to say we won't invest in those in the next 5 years, but I'm more curious in the next 5 years about areas that are slow growing, solid areas, limited risk, limited new supply, because I think those are going to be really strong performers and won't necessarily be hit by all the unpredictability of the highest growth markets.
Yeah, no, I love that. And one of the pieces of our framework when we're evaluating deals is really looking at that new supply percentage of new supply coming online relative to inventory. And when we see that go over 5, 6, 7%, that is a yellow flag. If it goes over 7 to 10%, that's a no-go zone. Because it means that we're going to be dealing with deliveries, concessions, price issues. And that's something we can look at the submarket level. And to your point, Doug, like, the availability of data now is just phenomenal. And it's so inexpensive on a relative basis. You couldn't get that data before 10 years ago. You might have to hire a person just to count the number of cars that went into the parking lots. Right now, you haul data, satellite images. There's just so much data available that you can leverage for a relatively cheap price, especially considering the amount of dollars that are at risk when we're talking about properties of this size and caliber. So last couple questions here. We'll go around the horn. Cody, best piece of advice you've received in your career?
Man.
One piece of advice that comes to mind. No, I'm just kidding.
All right, so has anybody said anything
you can think
to
of.
you today?
Drink 8 glasses of water a day, right? That's what my grandmother said.
Inspect what you expect. And it sounds silly and it's trite, but there's these I think Chris Williamson has this phrase of unlearnable truths, like these things that get said and they sound so trite, like money doesn't buy you happiness and all these things. And then you hear them, but you don't actually understand how profound they are until you truly have that realization. And yeah, I think inspect what you expect from property managers clear up through executives that are paid, exorbitant amounts of money. At the end of the day, you absolutely have to be in everyone's business.
Absolutely. Doug, now, best piece of advice you've received in your career?
No, I was certain we were going to move to a new question.
No, you each get the opportunity. You each got the opportunity.
I've got one if Doug needs to.
Okay, yeah, Hans, you go next.
I think what Cody just said basically is trust but verify. I mean, we do that with our partners. We did that even with you all on our partnership, right? I trust you guys implicitly, but we still read the documents. We still make corrections. Things are fine until shit hits a fan, and then everything changes. No matter how close you are, sometimes it's uncontrollable. So there's a good point by Cody. But I think mine, I wouldn't say this is the best necessarily, but it's a big one. And I think a lot of people forget, they overestimate what they can do in 1 year and they underestimate what they can do in 5, or you can say 5 and 10, or you can use whatever number you want, but singles and doubles add up, and it's better.
Yeah.
Really, I think and this is all kind of the same thing, play the long game. Singles and doubles add up. Things start snowballing, and if you just do a little bit every day and make progress, you will be surprised where you are in a year or 5.
Excellent. Doug.
I 100% agree with that.
Yeah, and mine's not necessarily, I'm probably not going to phrase it in any particularly correct way, but I would just say that people matter the most, maybe, and I'm just thinking in mind here of challenges. The industry is hard right now. We have properties going through challenges. We're having to turn around one. Some laws got passed in Texas that were unexpected that affected some properties. We have couple deals that have some problems. And I think what I'm reminded of, it's nice to have a team around you, people that you trust that are there to help you get through this, and I think we've all probably partnered with bad partners at some point, whether romantic or in business. And, I think these days it's really, for me, it feels really good to have people around me that I trust, to go through some of these, tougher experiences. And I think these experiences are going to be the things that we learn the most from and grow the most from and make us the best investors. Yeah. That, moving forward, that people, I'm always reminded coming out of, into the early 20s, everyone's like, hey, pick an investment with a good track record. And I'm like, they're all good. Everyone did well. No one suffered the last 10 years. You can't look at that. You got to look at who did well and when it was tough, who turned things around that were really hard. That's where you really see how someone performs. So I would just say the people around us are the most important.
Great. All right. That's all really good advice. And I know we're over on time, so I want to just respect your time and make sure you guys can get to your weekends if that's your next step. And we're the last of your meetings for the day. I just want to, if anyone wants to get in touch with, Hans or Doug or Cody, we're going to go ahead and just drop everyone's information in the show notes. So they'll have their social profiles, LinkedIn, Twitter, or I guess X, formerly known as Twitter, and other socials there. To the extent people want to get in touch with you or that you want people to get in touch with you, those will be in the show notes. Thank you so much for joining us in the Deal Flow podcast. And we will see you next week with another interview with a middle market allocator. So thank you so much. Enjoy the rest of your day.
Thank you.
Thank you.